Wall Street is preparing to turn artificial intelligence chips into something that can be financed like aircraft, office towers, or entire power plants. The number attached to the plan is more than $500 billion. That is larger than the annual economic output of many countries. And the company at the center of it is NVIDIA, the chipmaker whose hardware powers much of the artificial intelligence boom. But NVIDIA did not just receive $500 billion. It did not announce a single completed loan, and it is not personally spending the entire amount. What the company announced on August 10 is more unusual: partnerships designed to mobilize over $500 billion of third-party capital for AI infrastructure over time. The partners are some of the most powerful names in global finance: Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR. Together, they want to create dedicated financing platforms that can help NVIDIA's customers pay for the enormous data centers, chips, networking equipment, cooling systems, and power capacity required to run modern AI. The headline is about money. The real story is about risk. For most of its history, NVIDIA sold processors. A customer found the money, bought the hardware, and NVIDIA recorded the sale. The new plan reaches much deeper into the financial system. It is designed to make AI compute an investable asset class, capable of attracting money from credit funds, insurers, pension systems, sovereign wealth funds, and other long-term investors. In plain English, Wall Street wants to finance the machines that make AI possible, and NVIDIA wants to make those machines easier to buy. The timing is not accidental. NVIDIA's own financial filings identify capital, energy, and data center availability as crucial to future growth. Its customers may want thousands of advanced GPUs, but desire alone cannot build a data center. Projects require land, transformers, construction, cooling, networking, permits, and years of electricity. Even a company with strong demand can be stopped by the cost of turning a plan into a working facility. NVIDIA has already built an extraordinary business from this demand. In fiscal 2026, the company reported $215.9 billion in total revenue. Data center revenue reached $193.7 billion. That means the overwhelming majority of NVIDIA's sales came from the infrastructure now being transformed into a financeable asset. The company also reported a 71.1% gross margin for the full year. Selling AI systems is enormously profitable. But that success creates a new problem. How do you keep the customers buying when every new generation of infrastructure costs billions more to deploy? NVIDIA's answer is to connect the buyers of compute with the deepest pools of capital on Earth. The basic idea resembles familiar asset finance. An airline rarely pays cash for every aircraft. A property developer does not usually fund an entire skyscraper from one bank account. Investors provide capital because the asset is expected to generate income over many years. The aircraft carries passengers. The building collects rent. The power plant sells electricity. An AI factory sells computation. Its GPUs process training jobs, inference requests, video generation, coding agents, scientific models, and millions of other workloads. If customers keep paying to use that capacity, the revenue can support the debt and reward the investors. NVIDIA CEO Jensen Huang describes this with a simple phrase: compute is revenue. His argument is that NVIDIA systems are broadly useful, transferable between customers, and continuously improved by the company's CUDA software. In that view, a rack of GPUs is not just expensive equipment. It is a productive machine that generates billable tokens every hour it operates. That is the bullish case. The financing platforms could let smaller AI clouds and laboratories access hardware that only the richest technology companies could otherwise afford. More buyers could build more capacity. More capacity could lower the price of computing. And every new NVIDIA-powered facility expands the ecosystem around the company's chips, networking products, and software. NVIDIA benefits even if the third-party investors supply most of the money. Financing makes it easier for customers to purchase NVIDIA systems, while NVIDIA still earns revenue from selling those systems and gains a larger installed base for its software. But this is also where the uncomfortable question begins. If the seller helps arrange financing for the buyer, how much demand is truly independent? Imagine a company selling construction equipment, helping its customers borrow money to buy that equipment, and then pointing to the resulting sales as proof that demand is unstoppable. The sales may be real. The equipment may be useful. But the financing and the demand are no longer completely separate. Critics call this circular financing. NVIDIA and its partners see a new infrastructure market. Skeptics see a system in which the success of the chipmaker, the data center operator, the lender, and the AI customer increasingly depends on every other participant continuing to grow. Axios reported that individual opportunities would be evaluated case by case. In some structures, NVIDIA may provide a residual value support mechanism for up to 25%. That could reassure lenders if the hardware is worth less than expected later. It also means NVIDIA may retain part of the risk connected to the value of its own products. And value is the central uncertainty. An aircraft can remain productive for decades. A data center GPU enters an industry where NVIDIA itself introduces advanced architectures on roughly an annual cadence. New chips can perform more work using less power and lower the cost of each AI response. Hardware that appears scarce today could face much stronger competition or technological obsolescence tomorrow. The risk is not simply that a GPU stops working. It is that the revenue it can earn falls faster than the debt used to purchase it. Suppose an operator finances a massive cluster based on years of high rental prices. If newer chips make computation much cheaper, customers may move elsewhere. If AI companies fail to produce enough revenue, demand may weaken. If power connections or permits are delayed, the machines may sit idle. If a major customer fails, several lenders and infrastructure owners can feel the loss at the same time. NVIDIA's own filings show why concentration matters. In fiscal 2026, one direct customer represented 22% of total revenue and another represented 14%. The company also warns that customers can often cancel, change, or delay purchase commitments with little notice. A $500 billion financing system does not remove those risks. It distributes them. That distribution could make the system more resilient. It could also carry AI exposure far beyond Silicon Valley. When infrastructure debt is held through insurance businesses, pension portfolios, private credit funds, or securitized products, the people exposed to the AI boom may not realize they own a piece of it. None of this proves the plan is a bubble. Railroads, electric grids, mobile networks, and cloud computing all required enormous financing before their economic value became obvious. Society often builds transformative infrastructure with borrowed money. The important question is whether the assets will generate enough durable income to justify the price paid today. There is another reason for caution. NVIDIA's announcement describes memorandums of understanding, and the partnerships remain subject to final agreements. $500 billion is the amount the platforms aim to mobilize over time, not a vault of money ready to be spent tomorrow. Each project still needs investors, contracts, customers, energy, construction, and acceptable economics. So the announcement is both smaller and bigger than the viral headline. It is smaller because NVIDIA did not receive a $500 billion check. It is bigger because the company is trying to change how the global financial system thinks about computing. Chips would no longer be treated only as products that technology companies purchase. They would become collateral, infrastructure, and a source of long-duration cash flow. If NVIDIA is right, AI factories could become a new asset class beside real estate, energy, and transportation. The financing could unlock more computing capacity, accelerate adoption, and extend NVIDIA's dominance throughout the AI economy. If the assumptions fail, the same structure could reveal how much of the boom depended on cheap capital, rising hardware values, and customers that were never as financially strong as their demand suggested. Wall Street is not simply betting that NVIDIA can sell more chips. It is betting that those chips can produce reliable income for years, even as technology changes at extraordinary speed. $500 billion is not the conclusion of that bet. It is the size of the experiment.